Well, thank you, Dave, and good afternoon, everybody. Great to be with you. You know, the markets obviously have been in a historic type of a volatility here of late, and the key is you just have to know how to take advantage of it. So I'm going to share with you how you can hit home runs with options. You know, a lot of people make the mistake when they trade options, especially when they first buy options, that they try to swing for the fences, but then they strike out a lot. At Big Trends, we don't like to strike out a lot. We like to get the upside, but really manage the risk. And you're going to have some risk with any strategy, so I want to remind you of that as we go through the presentation today. But bottom line is that we'll talk about how we get out of trades that aren't working, as well as how to get into new opportunities. Just a reminder too that everything here that I share with you is for your information and education only. Nothing that I talk about here should be considered a specific recommendation of buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and staff are not responsible for any trades that you choose to make. And it's all about really finding trades that fit your risk reward profile. So consider the risk for any strategy. At Big Trends, we don't provide personalized financial, tax, or legal advice. What we do is we send out our home run options trades and our Grand Slam options service via real-time email and text alert to your smartphone. More on that later. And keep your tax advisor in mind that any strategy you do, it's going to affect your situation. So, you know, the baseball analogy, it's not quite a new baseball season yet, but getting close. We're in spring training right now, and obviously it's about how you focus, not on getting to first base with the strategy that I'm going to tell you. So we're really about getting to at least second base for what's called a double in baseball terms. That's a double of a plus 100% target on the first half of our position. The reason that's the first rule. I want to sell half of my position whenever I'm buying options with a strategy. I'll sell it out at a double, no matter how good it looks, or on a downside trade, no matter how bad it looks. Because the idea is, when you get your risk capital back, when you sell half of your position at a double, it makes you much freer and more able to ride for the even bigger wins. You don't get so antsy. I talked to a lot of traders and coached a lot of folks here at Big Trends, which I started in '99, and have been trading options for 30 years myself and teaching people how to do it for the last 3 decades. The bottom line is that it takes that edge off, and you won't be so worried. So then when you're targeting your next target of a triple, third base here is a triple, or 200%, in a return perspective, we sell half of our remaining position, and then our final target is the four bagger, the 300% quadruple. When that hits, we take the rest of the position off if and when it hits. It's not always going to hit, obviously, but the idea is that you got targets along the way where you take bigger gains out of the market. Now, this is definitely for more of a growth element to your portfolio. And I've talked to a lot of traders that are looking for income, looking for small, consistent types of success in their trading. I get it. There's something for everybody at Big Trends, but this is actually saying, you know what, we're going to buy relatively cheap options and go for growth on this part of our portfolio. I do both, but this has been working the best of any of my strategies over the last several years when you really add up all of the ups and downs and the really massive potential you get to even have one trade potentially make your year as a trader, compared to just buying and holding the stock market. So when we talk about buying an option at $1 or less, that means we're paying $100 or less to control 100 shares. So one contract controls 100 shares. So you can potentially start this when you're doing what I just shared with you, with as little as 4 contracts. You can invest $400 or less to get into a given trade. We're going to talk a little bit about the options Greeks and Gamma being the one that we're really benefiting from the most with this more aggressive options trading strategy. I'll share with you some of the indicators that I like to use. And again, I've looked at hundreds and hundreds and hundreds of indicators over my 30 years in options trading, and most of them don't work very well. You know, the reality is I've had to, kiss a few frogs, if you will, to find the real prince or princess. Pick your choice there to say, you know what, we want to find the best of the best. And the idea here is that, you know, these are some of the best ones that I found that work when the markets really get rolling to the upside or the downside. And then we'll walk you through this aggressive option strategy. Now, again, past performance is no guarantee of future results. So I don't want to, have you think, oh, well, you showed a lot of winners, and you know what, this last trade here, we just closed it out late yesterday in the market rally on DG. We closed it out for about a 44% loss. So that trade is no longer open. It's a minus 43 and 3/4. So we'll call it 44% give back on that last trade. Dollar General was acting good. It's a retailer. and then the market tanked and we had to get on out of it. But the beautiful thing is that when the market started to gap down last week, we actually made money last week in our Grand Slam options portfolio because we cashed out of the second half of our position in Barrick Gold. GOLD is the symbol, and we had already sold half of it at a double back there a day later. Actually, we got in on the 18th, the day after the President's Day holiday, and we sold the first half at a double. You see the plus 100 right here the very next day on the 19th. I don't mind when they keep going up. That's what you want, is to take a little bit of money off the table, get your risk capital back in your pocket, sell half the position, and then we'll usually try to sell another quarter at a 200% gain. Instead, GOLD didn't get there, and then it gapped to nearly that triple. We sold the remaining half at an average of 289% there on that Monday morning when the market gapped down the start of last week. Now, people might say, well, why didn't you have any put positions when the market dropped? The interesting thing is that I use a combination of a daily chart and an intraday chart. And while the intraday charts were going negative, the daily charts and most all the key things that I look at were still saying, you know what, you can't go bearish on these leading names. I only follow about 50 key names, and most of all of them have been bullish. So obviously, gold would be kind of a little bit of a contrary play to what's happening across the rest of the market. But saying, you know what, the rest of the indicator, the rest of the stocks are kind of mixed. We just said, let's just wait. And of course, now the options are pretty expensive with the volatility jump that we've had, the CBOE volatility index popping up to 40 here today again, as after I had the big rally yesterday. Surprise Fed rate cut today didn't goose the market any higher. In fact, it actually was a short-term top because the market's already anticipated the Fed was going to take that action. But the point here is that we were booking our profits in less than a week from the 18th of February to this past Monday, and up 289% of that second half. So you add the two pieces together and you're nearly a triple on your total investment. Notice, what did that option cost us? $59 per contract. Even if you're only trading 4 contracts as the minimum I'm recommending to get started with, that would be starting with $236 plus a commission of maybe a few bucks. You know, commissions have come down dramatically on options, which is one of the great reasons why you should be really strongly considering trading options even more actively, because commissions are down to next to nothing. But you can see we've had a lot of other successes, including an AMD double that didn't go on to its targets. We sold the second half at plus 60%, a Square call that doubled, and we didn't get the rest of the move. And it's still, look at that. If you say you gave back most of your profit, went back to a 15% gain on the second piece, add up 115, divide by 2, and you're at about a 57% total gain on the trade. We sold Tiva before earnings. It ended up gapping up, but we didn't want the earnings risk, so we only made 37% on that trade. So the point is, and then DG lost 44. So it's not perfect, and it won't always be that many winners against losers. Even if it's a 50-50 win rate, you can make a lot of money with this strategy. Let's look at the GOLD trade, for example, and we'll talk you through some of the indicators that we're going to teach you about here in this fast-paced session. Now you see the first indicator on this chart is, and we've got these what I call big trends bands on this chart, and they're a representation of the Larry Williams percent R, percent range indicator, which is shown that second panel here with the red line. And the red line, when it goes over bottom, what I want to see is that that red line's got to keep going up and close above that high. It did not happen on this first attempt back here in late January. So that was not a buy for that particular indicator. Where did it give a buy? When we broke above that high, and then we actually closed above it right here. So why didn't I buy it at the close there? Because I want to make sure my subscribers can participate. So I was getting in the next morning there, as you can see, back on the 18th, the stock was trading about 19 3/4, 1980, and we're buying a 20 strike call out in the March 20th expiration. A lot of 20s going on here. And you say, okay, buying a March 20 strike call right to buy the stock at 20, it's below 20. Why would anybody do that? Because we're anticipating this is going to go well above 20. As you see, it did. It went to 22.5 when we cashed out of our final piece here at that near quadruple. And again, like I said, the double happened the very next day when it went from about 1980 up here the next day to about 21. So you made about a 5% move in the stock, about a 100% move in your option. That next move was good for about just over a 10% gain, was good for almost a 300% gain in your option. So the leverage ratio actually expanded from about 20 to 1 up to about 30 to 1 by the time we cashed out of this trade. If you look at the rest of the chart for GOLD in the last week, it's come back down, started to pop back up the last couple of days, but still finished today under 21 bucks. So part of this is knowing when to get in, but the other part of it is knowing when to ring the register and get out. People always ask me, how do you know to take that final piece of the 300% gain? And it's just through a lot of trading examples. Sometimes I'll leave a little bit on the table, but a lot of times we'll catch it where that's about as far as they're going to go on this leg of that move. The other indicators on this chart here, you see in the second to last panel is what's called the CCI. And when that's going from the kind of trading range is blue up to the yellow, it's also in the same bar, the same confirmation. So both percent R and the CCI are both saying you should be buying into that close, or for our case, the next morning's open. And then the last one here is the ADX, the green line, the average directional movement. A lot going on, and obviously I'll try to give you just the highlights here, but you can learn all about it across my Grand Slam training as well as the trades that we call out. How about AMD? Here's another one where you can see the stock was breaking out here. Pretty much everything was starting to turn up on this particular bar. We want to see it continue to go up. So that's one of the things that differentiates me from a lot of other traders, is that a lot of traders will oftentimes fire their ammunition too quickly. When you see what you think is a breakout, it may well turn into a fake out and shoot back the other way. You saw this market actually do that today with a big rally yesterday. The Dow was up 1,300 points. You saw it shoot back down almost 1,000 points at the low today, and obviously finish down, get back more than half of that gain that we made yesterday after all the losses we had the prior week. Am I saying I'm bearish? No, but I'm saying that we've got a lot of volatility here, and you need to be careful to not get whipsawed by that. So I wait for what I call confirmation, which is now happening right in here as we move above that prior day's high. And you see the first couple of days we're stuck waiting on AMD. So sometimes you have to be patient with these. We're buying a pretty aggressive option. The stock's about 53 bucks. We're buying a 65 strike call out to March. A lot of people would say that's crazy. You're buying at 12 points out of the money. But you know what? Here's what I want to talk to you about. How do you get out of a trade that's just not doing much of anything? That's important, because when you buy an option that's out of the money, you can't afford to sit there and wait on it forever. So my rule is that we want to give it at least 5 trading days, right, about a week's holding period. And then if it's not profitable for us after the 5th day, then we're going to go ahead and blow it out. Now you can see actually on this one, we got 1 and 2 days where it's not really doing much for us. It's kind of chopping. 3rd day, it's profitable here. 4th day, more profitable. 5th day, we get our double. Okay, so now we saw half of the double, and now we don't want to see that start to roll over on us too much. And so what we do is we play some trailing stop rules. It didn't get to our 200% target as the next level. Started to roll over. You can see the next day, and we're out of this trade near the end of that first day's flip, where the stock went from about 59 down to about 57. So, we're looking for that continuation momentum. It's not happening. We blow it out. Good thing we did, because look at what happened. Of course, it got trashed like the rest of the market here over the next week. So part of this is knowing when to ride, and part of this knowing when to hold them, and also knowing when to fold them, as the Kenny Rogers Gambler song goes. Well, when I think of home runs, I think of the classic personification of home run hitter Babe Ruth, who, as you know, won a lot of World Series championships. He hit 714 career home runs. Interestingly, he hit almost twice as many strikeouts, 1,330 strikeouts. When I was developing this methodology over a lot of years, I was saying to myself, how can I get the home run upside but still not get killed on the downside? Obviously, anytime you invest in one of these trades, you've got to know that it's risk capital. You could lose what you put into it. Every once in a while, we get dinged and we do strike out, and we buy something for up to $1, and we might have to blow it out at zero. It might just end up expiring on us. That happens every once in a while, and you're welcome to contact us at bigtrends.com and review our full last several years track record on Grand Slam. I'll give you a way that you can reach us to do that. But that's why I always tell people, don't load the boat on any one trade. Just be really conservative, 5 to no more than 10% of your capital going into each trade. I like to hit big, like the Babe said. I don't like to miss big. We want to try to manage that miss as much as we can. But the big thing I see a lot of traders doing is they let, what the Babe says here on the left, let your fear start controlling you. You're in trouble in trading. If you never let the fear of striking out get in your way of getting back up there and taking that next swing at the plate. Obviously, we want to be more like the Warren Buffett philosophy of what he calls the fat pitch. We don't want to swing at every pitch. That's why we haven't traded in the last several sessions, because we're saying we're waiting for this market to kind of shake itself out and assert itself to the upside or for more downside potential for put trades. We'll talk about put trades too. But the idea is that we want to manage that downside while still getting the leverage that a home run can give you in your trading portfolio and your overall wealth creation. Now, the CCI has been one of those that hasn't been talked about a lot because it's, by definition, it's called the commodity channel index, but I've shown it to work with a lot of other stocks, especially growth stocks. So a lot of my names, which we'll talk about in a couple minutes, are growth names in big growth sectors like tech, healthcare, biotech, financial services, etc. Donald Lambert developed the CCI, and the reason that the CCI is, to me, very unique and useful is it doesn't just look at closes like a lot of other indicators do. It actually will measure high plus low plus close divided by 3 to get what Lambert calls a typical price for the day. And something that's closing near the highs is going to pick up, like a close is equal to a high if it closes at the high. So you get 2 highs and a low divided by 3. That's going to have a bias, a pull to the upside. Likewise, it closes at the low, 2 lows and a high, pulling to the downside. One of the big differences that you'll learn from big trends is that when you hear the word overbought, just about all my testing on any trend following method says you want to own and ride stocks in markets that are going overbought and staying overbought. That's where the best money is. That's where the institutions really don't care about paying too much for a situation if they think it's going a lot higher in the future. So the reality is that institutions who drive the market, you and I as individuals, don't. The reality is the institutions are going to keep buying a good earnings situation, a good news scenario, the next Apple, the next what have you, and they want to keep piling in, and so they'll buy it in market dips, they'll buy it in market rallies, they'll just keep working their way into the position. Likewise, so that's a big positive that can go a lot higher, not something that you should sell. Likewise, oversold can be even more bearish because the institutions are getting out. They know there's more bad news coming. Those are potential put trades. So the reality is that the other indicators that I use, the ADX, the average directional movement, developed by Wells Wilder, looks at how much net new highs you're getting, what's called DMI plus, how much net new lows you're getting, DMI minus. And the gap between those two creates the average directional movement. And when that's rising, that tells you we've got a trending market. So I don't have enough time to go into all the nitty gritty of these indicators, but you're going to see a picture's worth 1,000 of my words on these examples. Like here's Baidu. And this is that big trends band I was just talking about. The Williams %R, we break outside of that and we keep on going more and more overbought. We keep accelerating to the upside. And so we're going above what's supposed to be holding as a resistance because it's not a range anymore. This blue line shows you it's a trend. Now you can say, well, gee, we sold that early, 300% within 4 trading days, and it went even higher over the next couple of days in particular. But the reality is, overbought is where you want to ride this power trend up. So the big trends bands will show you how a stock can stay in that top percent of the top 20% of the overbought readings. That red line that's supposed to be bad is actually really, really good time. You see how there's something not matching up where overbought's not bad anymore. Overbought's very good. So that's what we're going to show you here. And as we show you that, adding up all the indicators, there's the %R breaking out, the big trends band breakout here. That was coming in after the ADX was starting to turn up a little bit early. See, I'm not going to buy when one of these indicators turns. I want all of them to come up. CCI came in a day later, and that's where we were getting in here on Baidu when the stock was trading down the high 100s, like the 190 zone. We bought 210 calls, and it rallies a quick 20 or 30 points. And as we go from out of the money to in the money, that's where you get a lot of bang for your buck. Another example on Baidu, here's one where the ADX, I'll put an A on it here for a reminder, ADX is trending up here, but we're not getting that breakout out of this little wedge after earnings until it starts to come in here near the close of this day. We buy the next morning. And then you see here that the %R is also broken out. That's the red line in the middle panel. And then the CCI here breaking out right into where we're getting into the trade in this zone here. So 100, 200, 300% in 6 trading days. What you're really looking for here when you trade these Grand Slam situations is you're looking for speed of movement. Speed of movement going from out of the money to in the money is how you make the most money as an option buyer. It's an aggressive approach because if you don't get the speed, obviously you can get left, where that you're really seeing that now you're seeing a position work against you if it's flat or against you. We've got to see that price movement in our favor within the 5 trading days after entry, or else we blow it out. Now, the options Greeks, you may have heard some of these terms. I don't want to get you worried about it if you're new to options, but the idea is that most people focus on delta and looking for an option that's got a high delta, meaning that the stock goes up $1. You want your option to go up as much of that buck as you can. But ironically, you make more money if you buy an option that has the highest gamma, which is how fast you will pick up deltas. So if delta starts off at 30%, the next point it goes to 40%, the next point 50%, you're getting gamma jumps of 10 points on each successive point move in the stock in your favor. Here we're looking for not just a 1-point move, we're looking for multiple points in our favor. The thing you've got to worry about when you buy options, of course, is the theta. That's the time erosion or time decay. And so we'll look at that chart here in a minute and talk about how we manage that. We don't care about Vega for this because we're not worrying about volatility changes. Right in front of earnings is where you'd probably care more about that. But, I mentioned GOLD already, and I've had this in my presentation for a while because a prior example of this, when it used to be called Randgold Resources, it merged with Barrick Gold. Now the company's called Barrick Gold. Of course, Barrick's a huge gold company. Randgold was a name that I've followed for a number of years and talked about very positively, and they finally got bought out by Barrick. But the reality is this was a case where the stock was trading about 100. We're buying 110 calls after avoiding these other couple of fake out moves, because you can see while percent R looks like it's getting going in here, the CCI is not. ADX is not getting going yet. Then CCI comes right into a key test here, but doesn't get going here, so we don't take that one either. It's when it's finally breaking out through that resistance right here that now we're getting on the wagon, riding this horse to the upside as it rallies more than 10%. The first 2-day gap up about 5% of the stock was good for 160%, more than a double on the first half of our position. So we're already at a nice profit position, taking more than the double on the first half in this case. 200% happens. You can see about the 6th day in, and then the 8th day in, 300%. As it turns out, that's the exact peak. Put a 3 on that. That's the 300% level there, and we get out at the top. People might say, "Oh, you're just hindsight 2020 it." No, that's actually what we did. We didn't know it was going to stop there. We're just saying that's about where historically we see that some of these stocks will take a pause. So we want to make sure we're locking those profits in, moving it into the next situation. Now, when I talk about the time decay curve, a lot of people would look out and say, okay, if this is the expiration day at 0, where the option has no more life left here in the bottom right part of the chart, they say, well, clearly you should buy out a lot more time so you don't have a whole lot of decay. If you buy this for a month and you see you don't lose a whole lot of time premium on that option, versus if you buy it with 30 days left, you can see a whole lot of that decay is happening there. So why would I consider buying it with about 40 days, even to just under 30 days to go before expiration? Because if I know I've got a 5-day sliver of this chart here, so this is 5 days, every 5 days, you can say, sure, you're losing a little bit here, but when you can pay a lot less for the option, you're getting a tremendous extra leverage when you catch that directional 5-day window correctly. If you're sitting there saying, well, the 120 days is a lot safer of an option as a buyer, it may be from a decay perspective, but you're going to pay multiples of extra time premium and extra cost. And that's going to really make it hard for you to hit a double or a triple or a quadruple if you pay too much for the option. So it's really about capitalizing on the sweet spot. That 5-day time stop is the key. The other key is I will not hold these Grand Slam trades once I have 14 days left. No matter how good the trend looks, at 14 days, I am out because the decay rate's too fast in the last 2 weeks before expiration. Don't trade in the last 2 weeks before expiration with this strategy. It's too risky. So there's always a point where you say, okay, that's a breaking point. We don't want to do that. Now, you see some of the names that I love to trade for my Grand Slam options traders. They have consistent trends up and down. Of course, a lot of tech names, there's including the China tech like Baba and Baidu, obviously in focus with everything going on with China, both the trade war side and, of course, most recent coronavirus news. But the bottom line is that you can see a lot of financials from Goldman, MasterCard, Visa, and more. As I mentioned, Randgold is now named Barrick Gold. Schlumberger has been probably my favorite oil name to trade up and down. And you can see there's some classic tech like NVIDIA. Some of the casino stocks, Wynn and Las Vegas Sands, considering those, their premiums are quite expensive right now because of the news that's come out recently about Macau and other stuff getting really whacked. So, you have to make sure that you get the right price for these options. So I'm not going to trade it just because the chart says I should buy if the options don't look attractively priced, and more on that in a minute. But sometimes a name that's like Best Buy, you think that's kind of a slow name, right? A retailer, bricks and mortar, electronics leader. But bottom line is, a lot of people think that Amazon's going to clean their clock. Well, you know what? It's still done really well for us. And you can see in this case, this is off of the other charts were trade station charts. This is actually a thinkorswim chart. Percent R's breaking out here first, right there. Why don't we buy it there? Well, you can see ADX doesn't come in until a few bars later, and then CCI as well. So we're getting in there. Actually, say it looks like we're in late. And this is something you have to deal with as a trader, as you say, okay, you know what, the stock's about 63 bucks. We're buying a 67.5 call for 80 bucks a contract. So if you bought 4 contracts, that's 320 bucks. Our model portfolio is based on typically putting $1,000 in a trade on a model $10,000 account. So that would get you like 12 contracts on $1,000 bucks. The beauty of this is scalable. As you get more confident, you can always build your size up. And as you grow your portfolio, you can of course scale up appropriately. But you see all these things, now the ADX is in red here, but it's trending up here off of a low level. So even though we're wrong, these next 2 days, stock drops the day after we get in, starts to recover a little bit. Third day, it's back to positive. Fourth day, it's still above where we got in. Fifth day, it's above where we got in. We're just slowly riding this trade. You can see it takes it the 9th day here before we get our double on that first piece of the trade. This is why it's important that you buy out enough time. So we're buying out at least a month. In this case, from early December, we're buying out to the middle of January, about 6 weeks away. And so it's doing what we want. It's just kind of a slow boat. Then the 200% is happening here as of about the 16th day, 15th day, it looks like here. And then the 20th day, our trailing stop gets hit on the rest out at 118% on that final piece. So it makes for a really nice steady trade. That's about as steady of a trend as you can see in this kind of a situation. At this point, ADX rolling over, that's a question mark about does the trend continue or not. You want that ADX trend to be rising. And then we do look at more than just a stock chart. I like to look at the options chart that we're buying as well. Why would I care about an options chart? I even had well-known option strategists tell me, why mess with it? It's just a derivative of the stock. Well, actually, no. An option is a time-limited asset. It's going to have an expiration. If you buy Apple stock, it'll probably outlast you and me both with how much cash they've got in the bank, 100 billion plus, right? But the Apple 1 month calls are going to expire a month from now. So you got to get your timing right on the time limited asset. Also, the volatility changes. You've got to pay the right price for the option. So the option chart will look quite different. Take an example with Microsoft. One of our best success stories where we bought Microsoft breaking out here before earnings. We were able to cash it in for the double here. The 100% happened here about a week later, maybe you can see here about 7 trading days later, we make 100%. We bought this option for 55 bucks a contract. 55 cents as it's quoted. So the first half at $1.10. Flat lines before earnings, we say, look, we've already gotten our risk capital out of the trade. The trend is still good. Percent R is good. CCI is good. ADX is still trending up here. We want to stay with it. Stock's about 79 bucks. It gaps up about goes to 84.30, up about just a little over $5, and we make 756% on the second half of the trade 11 trading days later. If you look at the options chart, interestingly enough, the option chart was just breaking out right as we were cashing out at our double. We liked it before on the intraday options chart, but the daily was just picking up. And then this was giving us what we call a retest here, right around $1. We don't want to see this option go below $1 on an end-of-day basis. That would have violated this key retest point here. We stay with it because it holds that $1, and then it opens at $4.71. That's where we cash out. Goes to 6, back to 3. It's one of those, you can't get worried about trying to be perfect with this scenario. You're just looking to get your targets, take the money, and run. Here's one with Mylan Labs. You can see the stock's 62 cents when we get into it. And I always say the longer, it's not my comment actually, it's been out there for a long time, the longer the base, when you do get one of these breakouts, percent R, ADX comes in, and then CCI comes in with ADX, we're buying in here when the stock's about 40.5, we're buying a 42.5 call, about 5% out of the money, 62 bucks a contract. It takes 13 days for us to get our final 300% target, as well as our partials about the 10 and 11 day mark. So you can see it's just steady as she goes. So we get that gamma boost with this options buying approach. We use the option charts to confirm it. We're now up to about 50 stocks that are tailor-made growth stocks for this kind of a strategy. I mentioned Schlumberger. Here's another one that had a long base. This is in a prior period. Obviously, the oils have been getting killed here lately. But the bottom line is that long base, it finally breaks out through this key point right here, breaks through that right at the start of a new year, and it just launches straight up for about a week and a half. Our dollar option goes to ultimately $4 on the 5th trading day into the trade. So we're buying about a 72.5 call when the stock's only 69. It's barely out of the money. Thought it was really attractively priced. Here's another one with Akamai, not a household name, but is a big name to watch in the tech sector. It should be on your list. Long base, long resistance, starting to finally break out. This is where the structure is changing for this chart. You see that the ADX is starting to trend up. Percent R's already started to go. CCI comes on board, and then the thing takes off. And what's really cool is you can even see it on the intraday chart. This is a 30-minute chart on Akamai, and you can see a couple of phases while we're in this chart. The first phase, we're riding through a choppy period, and then it starts to kick up here on the intraday. So this is why I really use intradays a lot. The last intraday chart here is where we got all 3 of our targets, double, triple, and quadruple on the 7th day in the trade. That's kind of unusual, but you can see there's CCI going ballistic. There's percent R going ballistic. Everything, all systems go. What about on the downside? Here's Alibaba starting to break down. We're starting to now get the ADX upturn, but you can see now the negative directional movement in red's above the positive directional movement in blue. So from that perspective, that's now a negative trend. The stock gaps down the next day, gets us our double the next day, and then it starts reversing after gapping further down. It starts to do this hook here back up, and that's where we get our trailing stop hit, 69% of the second half of the position in just a couple of days. Good thing we got out before it flatlined or worse on us. Here's U.S. Steel. It was not helped that much by all the tariffs and all that hype. And here's where it was breaking down on this first bar down here. You can see that big red candle. We don't get bearish there until it closes underneath there, which happens 2 days later. So we're getting in this next morning. It's a little bounce here to about $32. We're buying the U.S. Steel ticker X. 30 strike puts at $86 a contract. Took a double on the first piece. It got to about 150%, but then it started to flip against us, and we got 66% on the next piece. So again, averaged about an 83% gain on the whole position. So, when you think about what are your keys to really take advantage of this daily Grand Slam option service, first of all, you've got to have a catalyst. It could be a fundamental catalyst. I do watch earnings surprises particularly closely, and I'm looking for the stock action to confirm that the earnings are truly a big surprise. It's going to push the institutions in. Could be a volume surge. Could be a breakout, but most of this is technical breakout or breakdown related. These are going to be out of the money options. That scares a lot of people because they say, okay, well, it's not worth anything until it gets a move in your favor. But the reality is those are the options you can buy cheaply, and then we're looking for that trend move to take them from out of the money in the money, and that gamma pickup is where you can really hit your big home runs quickly as you gain deltas on a several point move in your favor fast. If it's not working after 5 trading days, get rid of it after that point. We call that a time stop. It's different than a price stop. It just says you don't get stuck in a choppy situation that's just not validating it. Sell half at a double, another part of your position, a quarter of the original at a triple, the final quarter at 300% on gaps in your favor or targets getting achieved. Don't overcommit. No matter how good it's been awfully good for our Grand Slam subscribers here. For quite a while. Bottom line is that we say no matter how good it is, don't overcommit. 5 to no more than 10% of the capital that you allocate for the service going into each new trade. And then we give you weekly video training, so we're always teaching you how to trade and look for these yourself as well. So here's one with Visa. Visa has been very good to us. The stock was trading about 192 here. We're buying a 205 strike call. 13 points out of the money. We're wrong after 2 or 3 days here. It's just chopping. 4th day, we're back to slightly positive, and then 5th day, we're positive. We're staying with the trade. 8th day, we're taking 100%, and then 200 and 300% on the 9th day. Thank you very much. This one went even higher before it collapsed back down. That's okay. And we showed you the gold example now. It probably makes sense to you where percent R breakout, CCI breakout, ADX turning up. All those systems go and then falling through. That's why we got on there that morning, I should say the 18th, February 18th, to take advantage of that. So past performance does not guarantee future results. If you took all the trades, putting in no more than $1,000, winners and losers from the start of 2017 to present, you can see you'd be up. It's actually more than this now, but you'd be up over $27,770 on a model portfolio of 10K. You'd be up to 37, now over 38K. On options priced at $1 or less a contract. So it's a beautiful way to take advantage of this. I'm going to share with you quickly how you can take advantage of this. Usually, I just did a special for my Grand Slam subscribers where they know they were paying several $1,000s on my website. I said, I'm going to give you a break here. I'm going to give you 12 months for $997, 24 months for $1497. But I told Dave, since Festival of Traders and Dave have been so good to me, I'm going to do an even better special for you. When you go to this page here at members.bigtrends.com/slam that Dave has posted there, thank you, that you say, okay, you know what? When you go to that page, check out what you're going to get. It's going to pop up this really simple order page, which says you can try the next 30 days for just 47 bucks. And why don't I give it to you for $1 or $7 or $9? Because obviously I'm not going to give it away for nothing. You got to make a little bit of a commitment. But the idea is that, okay, if you like it after 30 days, if I'm making the kind of money that we've been making for our Grand Slam subscribers, after 30 days, it'll renew a month from now at $147 every 30 days. And what I'll do is, if you like it in the first 30 days, if you let me know by the 29th day before it's going to rebill at $147 in 30 days, I'll let you apply the 47 to either the 12-month special I just did for my current Grand Slam folks, or the 24-month special at the $14.97. So you say that seems like a lot, but if you are making the kind of money we've been making for Grand Slam, you're going to say, gee, that's an easy application and get even more value on those 12-month and 24-month specials that I just did. But 47 bucks for you to try it for the next 30 days. No taxes unless you're in the state of Kentucky where I'm at. All you do is you go to that link and you go ahead and click the checkout button. Get your key information here in bold. Type in your email twice, because we do email you the trades. But also, after you get whatever credit card you want to use in here, we take the major ones that you can just click that you saw it with me on this webinar. But this customer notes is what I want to point out to you real quick. Two special things that you get as a subscriber to the service. You get the text alerts added at no additional charge from me. Just make sure you have unlimited texting. And we do ask that you tell us when you type it in there, when you want to get the text alerts, which service you use, AT&T, Verizon, Sprint, T-Mobile, you name it. Type it in there and we'll make sure you're on the right batch file to get this. Review the conditions and terms, because this is an automated renewal service. You're buying the first month for $47 and then it'll renew automatically at $147 30 days from now. If you want to cancel, we give you several ways to do that in that auto renew part of the terms and conditions that are spelled out in full on that link. So the point here is that it's a great way to get started. The other point I want to make too is that the one complaint I get from some subscribers is, I work a day job, I can't do this. Well, you can actually have this auto traded across a couple of options focused brokers. Thinkorswim as well as auto shares can help you to auto trade that, and you can take advantage of those trades automatically by locking that down. If you don't have an account with one of those and want to set it up, lock in the $47. You can actually tell us, put it on hold while you set up your account. We'll turn it back on and start your 30 days once your account's set up with one of those auto brokers. It's another great way to go. So remember, go to members.bigtrends.com/slam, not www, but actually members.bigtrends.com/slam. You can also, you see from, if you have any questions, you can also reach us at 1-800-BIG-TRENDS, which is our Big Trends toll-free number, or you can also shoot us an email over to clientcare@bigtrends.com. Make a note of those. But the one you want to go through is this clickable link that Dave posted up here, members.bigtrends.com/slam, to get 30 days access to our Grand Slam service, and then it will rebill at $147 after this upcoming month. I know you're going to learn a lot, and I'm confident that you're going to see a lot of opportunity to make it well worth your investment for many years to come. If you have any questions along the way, let me know. Thank you, Dave, for hosting me. I want to make room for our next guest, and thank you all. Wish you great success amid these volatile markets.